If you work in tech and you have a single stock position worth more than $1 million, there's a very good chance someone has pitched you on an exchange fund in the last year. And on paper, the pitch is incredible. You take your concentrated position in NVIDIA, Meta, or any pre-IPO stock, you contribute it into a fund, you get diversification immediately, and you legally defer the entire capital gains bill, which in California can run as high as 37%. The problem is, the pitch typically leaves out the parts that actually decide whether this is a great move or an expensive mistake. So I'm going to walk you through both sides. Real numbers, real examples, and a clear framework for when an exchange fund is the right tool and when you are better off doing something else entirely. Quick context on me. My name is Andy Vandenberg. I'm the founder of V2B Wealth, and I spend most of my time helping professionals in tech and other industries navigate concentrated stock, equity comp, and the tax decisions that come with big liquidity events. If that sounds like you, stick around to the end. I'll tell you the best way to get in touch. Here's the plan for the video. First, we're going to talk about what an exchange fund actually is in plain English. Second, why they exist and why the IRS lets you do this. Third, 3 real-world tech employee scenarios where the math works. Fourth, and this is important, the cons that almost no one talks about. And fifth, the alternatives you should weigh before signing the official documents for an exchange fund. So let's get into it. An exchange fund is a private partnership, usually structured under Section 721 of the tax code. The idea is simple. A bunch of investors, each holding a big concentrated stock position, contribute their shares into a single partnership. In exchange, each investor gets units of this partnership. The partnership ends up owning a diversified basket of all the contributed stocks, plus, importantly, some real estate. So here's the magic part. Under Section 721, when you contribute appreciated stock into a qualifying partnership, that contribution is not a taxable event. You did not sell anything. You just exchanged it. So the capital gain you would have owed if you sold the stock outright gets deferred. You have to hold the partnership for a minimum of 7 years, and after year 7, you can redeem your units and you receive a diversified basket of stocks back in kind. Your original cost basis carries over to the new shares, so you have not eliminated the tax, you have just deferred it, and you have diversified along the way. One important technical detail that I think often gets overlooked. The fund cannot be made of 100% stocks. By IRS rules, at least 20% of the fund has to be in qualifying non-securities assets, which in practice just means real estate, also usually held through separate private partnerships. That 20% sleeve is the price of admission to get this great tax treatment. And we'll come back to why that matters when we get to the cons. Now, why am I making this video specifically for tech employees? Because the concentrated stock problems in tech is unlike anything else in personal finance right now. Let's take NVIDIA. On January 31st, 2023, NVIDIA closed at a share price of $19.52. On May 14, 2026, just 12 days ago, NVIDIA hit an all-time high of $236. It's a 12-time return in a little over 3 years. So if you're an engineer at NVIDIA and you have been investing RSUs since 2023, your equity comp is now the dominant risk in your entire financial life. Your job and your portfolio are now the same bet. And the trap is this. The moment you try to sell down that position, you trigger massive capital gains. In California, the combined federal and state long-term capital gains rate at the top bracket is 20% federal, 3.8% net investment income tax, plus 13.3% California. That's over 37%. So you're stuck. Hold the position and accept the concentration risk, or sell and write a 7-figure check to the IRS and the franchise tax board. This is the exact problem exchange funds were invented to solve. Let me make this concrete with 3 scenarios. Scenario 1, the long-tenured NVIDIA engineer. You vested $500,000 worth of NVIDIA in early 2023. Today, that position is worth roughly $6 million. Your embedded gain is about $5.5 million. If you sold it all at the top California rate, your tax bill would be just over $2 million. That is real money, and it permanently leaves your portfolio. If you instead contribute that $6 million into an exchange fund, you owe 0 in capital gains tax that year. You immediately have exposure to a diversified basket instead of a single stock. You wait 7 years and you redeem. You get a diversified basket back, and you can decide then whether to sell, hold, or pass it along to your heirs. If you hold it until you die, your heirs get a step up in basis under Section 1014, and that $2 million tax liability evaporates entirely. Scenario 2, the long-tenured Meta engineer. Meta went public in May of 2012, $38 a share. Today, it trades at around $600 a share. So if you joined in 2013 or 2014, and you have been investing RSUs the whole time, you have had multiple grant vintages with cost bases running from the high teens to the low triple digits. Your embedded gain could easily clear $5 or $10 million across the position. For this engineer, an exchange fund can defer a federal and state bill, that might otherwise consume $3 or $4 million of after-tax wealth. The 7-year lockup matters less when you're 42 years old and you do not need that money for retirement for another 15 or 20 years. Scenario 3, the pre-IPO employee after lockup. You were employee number 50 at a startup that went public 18 months ago. You exercise options early, so your cost basis is under $1 a share. Your lockup just expired. You now have $3 to $5 million in a single newly public name. The stock's been volatile. You want to diversify yesterday, but selling triggers tax on basically the entire position. An exchange fund lets you diversify on day one of eligibility without realizing the gain. In this scenario, the case is almost a no-brainer if you can meet the minimums. Now here's where I'm going to slow down, because this is the part of the conversation that the salesperson at a wirehouse or someone promoting exchange funds rarely talks about. There are real cons here. Con number 1, 7 years is a long time. You are locking up that capital for 7 years. If you need liquidity for a house, a business, a divorce, a medical issue, really anything, you cannot get to it without breaking the structure. Some funds may let you redeem early, but you get your original shares back, not the diversified basket. There's often an early redemption fee of over 2%. So you lose all of the benefit of the structure and you potentially pay to lose it. Con number 2, the fees compound and they are not small. Traditional providers typically charge in the neighborhood of 1% annually or more, sometimes with additional upfront and exit fees. Over 7 years, even at 1%, that is roughly a 7% drag, which eats meaningfully into the tax benefit. There are new entrants that have pushed minimums down lower, and they've also reduced management fees, sometimes even below 50 basis points. So it's important to run the math for yourself. If you save 37% in a deferred tax, but pay 1.25% annually in fees for 7 years, your net benefits are still great, but they're not as exciting as the headline. Con number 3, the 20% real estate sleeve. Remember that 20% qualifying assets requirement? In practice, that means a chunk of your supposedly diversified equity portfolio is actually in private real estate, which is illiquid and often levered. That may or may not be what you want. If you already own a home and you wanted broad equity diversification, you just paid for exposure you did not ask for. But if you want real estate exposure, it could be a good feature. Con number 4, you get stocks at the end and not cash. After 7 years, you do not redeem to cash. You get a basket of around 25 to 30 individual stocks distributed in kind. So if your original goal was to fund a near-term liquidity event, an exchange fund does not solve that problem. It mainly solves a diversification problem and not a cash flow problem. You will still pay taxes. Con number 5, deferral is not elimination. This is the crucial part and one that people miss. The tax does not disappear, it is just deferred. When you eventually sell the basket, you owe tax on the gain measured against your original low basis. The only way the gain truly disappears is if you hold the units until death and your heirs get the step up, which is a perfectly valid strategy, but it has to be your actual plan. So when should you not use an exchange fund? Let me give you 5 disqualifiers. 1, you may need the money in the next 7 years. If there's any meaningful chance you need liquidity for a real estate purchase, a business funding round, or a major life event, don't lock it up. 2, your position has not appreciated all that much. As a rough rule of thumb, if your concentrated stock has appreciated less than about 50% over your basis, the fees in an exchange fund will often eat more than the tax benefit. Obviously, it depends on the balance of stock you have, but direct indexing with tax loss harvesting could be a better tool in that range. 3, you are a founder or very early employee with stock that qualifies small business stock exclusion under Section 1202 or QSBS. As of the One Big Beautiful Bill Act signed in July 2025, QSBS was meaningfully expanded. For qualifying stock issued after that date, you can now exclude up to $15 million per issuer of gain with a tiered exclusion that hits 100% at 5 years of holding. QSBS eliminates that gain entirely on that slice. An exchange fund only defers it. For founders, you are almost always want to use QSBS first and exchange funds second. 4, you're charitably inclined. If you plan to give meaningful dollars to charity, donating appreciated shares directly or using a charitable remainder trust can completely eliminate that gain on the donated slice, often with better outcomes than an exchange fund. 5, you are very close to retirement and you actually need to spend the money. Locking up the bulk of your portfolio for 7 years does not work if you need it to start paying you in 2 years. Before you sign anything, you should price out at least 3 alternatives. A 10b5-1 plan combined with scheduled diversification is the simplest option. You sell down the position over 2 or 3 years, you pay the tax, but you keep liquidity. You avoid lockups and you avoid layered fees. For many tech employees, this may be the simplest and best answer. Direct indexing with tax loss harvesting can help offset hundreds of thousands of dollars in gains over time by intelligently realizing losses elsewhere in your portfolio. A charitable remainder trust can convert a concentrated position into a tax-efficient income stream while supporting a cause you care about. And a donor-advised fund lets you front-load multiple years of charitable giving with appreciated shares in a single high-income year, often the year of an IPO or a large vest. In practice, the right answer is usually a combination of 2 or 3 of these strategies, and not just a single product. Here's the honest summary. Exchange funds are a real, legitimate, and often powerful tool. They are most useful when you have a single position worth several $1 million with very significant embedded gains, where you do not need liquidity for at least 7 years, and where holding to death or to a future low-income year is a realistic part of the plan. They are the wrong tool when the fees overwhelm the tax benefits, when you have a better alternative list like QSBS or charitable strategies available, or when you just care about liquidity and simplicity. The reason this is worth thinking carefully about is that the decision is largely irreversible. Once you contribute, you are committed for 7 years, so get the analysis right before you sign. If you're sitting on a concentrated tech position and you want a second opinion of what to do with it, I'm happy to take a look at your specific situation. The best way to reach me is through the link on the description below. And if you enjoyed this video and got any value, I'd appreciate if you hit subscribe and like, and I'll see you in the next video.